Hello, my name is Douglas Arner, and this is Looking Back, Looking Forward, April 2023. This time, I want to talk about the four crises that we're seeing really at the same time in the context of financial services. I think if we look back on this time period in a few years' time, we'll look at first what we call the crypto winter of 2022, 2023. And the crypto winter is really all about tech and financial cycles. And we see in 2021 a very high run-up in the prices of Bitcoin and a range of other digital assets. And we see across 2022, for a variety of reasons, those prices beginning to come down. And as usually happens in the context of the financial sector, when asset prices start to come down, you begin to see strains emerging. And we see in the crypto winter, we see first the failure of a project, a stablecoin project, linking Terra and Luna. Then we see the failure of an asset management firm, Three Arrows Capital. We see several other issues arise, culminating in the failure of FTX, a so-called exchange, one of the major intermediaries operating in the crypto space. And if we think about this first of our four crises, if we think about what to do about the crypto winter, really I think the key point is that over the past 14 years of the evolution of the cryptocurrency ecosystem, we've seen very similar sorts of issues arise to those that we've seen arise in the context of financial services. We've seen issues of interconnection, of concentration, similarly to what we might think of in traditional finance as too big to fail or too connected to fail. In other words, financial stability issues, though limited to the crypto ecosystem. We've seen lots of issues about lack of information and problems with market efficiency and market functioning. We've seen lots of issues with consumer and investor protection, around fraud, around misconduct, around behavioral issues, centering not so much from the technology, but from the behavior of the humans using that technology. We've, of course, seen a range of market integrity issues relating to money laundering and criminal use of the crypto ecosystem. And we've seen a range of issues relating broadly, both positively and negatively, from the standpoint of innovation, inclusion, and development. And all of these experiences basically lead to the conclusion that despite many of the arguments otherwise, the crypto ecosystem has evidenced over time many, if not all, of the same sorts of market failures, externalities, and problems that we see with traditional financial services. And as a result, from the standpoint of going forward, for the crypto ecosystem to work, we really need to focus on the same sorts of issues. Licensing and regulation of the various forms of crypto intermediaries, disclosure standards, and information trustworthiness approaches like accounting and auditing. Things for investor protection, in particular, regulatory involvement to police fraud, misbehavior, and other sorts of crime and issues. Third, around the context of market integrity. Know your customer requirements to keep out criminal and other sorts of problematic users. And finally, these systems all go together to maximize the benefits while minimizing the risks of these innovations and new technologies for broader sustainable development. Our second and third crises are very much related, and one can think of this as a tech bank crisis, which initially starts from problems in the crypto ecosystem that spread to Silvergate Bank in the United States, which was the major bank for many of the crypto participants to link between the crypto ecosystem and traditional finance. As issues arose in the context of the crypto ecosystem, we see customers withdrawing their funds from Silvergate, problems emerging both on the funding side, its customers withdrawing funds, but also from the standpoint of its loans and investments, as customers and their businesses experienced problems, failed, or had problems otherwise repaying loans. But nervousness around the Silvergate failure led to investors looking at other banks with similar sorts of issues. In other words, looking to banks which might have exposures to crypto, but then broadening this to look at exposure to tech and the tech cycle and potential tech losses more broadly. And in addition, firms which might have a very concentrated depositor base and or lending and client base that could make them particularly exposed to issues in the context not only of the crypto cycle, but also of the broader tech cycle. And we see this coming together particularly in Silicon Valley Bank, a bank based in Silicon Valley whose business centered around taking many tech companies and venture capitalists as its core depositors, but also as its core customers. But what was different about SVB, and I think one of the most interesting aspects of the tech bank crisis of 2022, was the speed with which deposits left SVB. Basically, we see in SVB an example of the classic problem that any bank, no matter how good its asset portfolio of loans and investments, and SVB certainly did have some problems there, no matter how good its assets and investments, if all of a bank's depositors, all of its funders, remove their funds or try to remove their funds at the same time, the bank will fail. And what was interesting, particularly with SVB, was the speed with which new technologies, particularly mobile banking, but also social media, incentivized and allowed movement of funds out. SVB lost almost a third of its entire deposit base in one day and was set to lose another 2/3 of that deposit base the next day. And I think as we look at SVB, it really requires us to focus in on thinking very carefully about the implications of technology for banks and banking supervision. And I think one of the key lessons is both that banks must implement more sophisticated technologies to continually monitor their positions, but also regulators and central banks need to make sure that their liquidity processes, their supervisory processes operate on a real-time basis, on a 24/7 basis, and that they are monitoring not just traditional metrics, but also an increasing range of social media and other forms of communications, because the speed of communications, the speed of connections, means that issues can spread faster than we've ever seen before. Next time, we'll look at our other two crises. Our third crisis, Credit Suisse, and what Credit Suisse combined with the tech bank crisis might tell us about banking supervision in the future. And finally, the last piece, that fourth crisis, which is all around developing countries and the financial crises they are experiencing, and the linkages, what ties these four crises together.